As an investor, you're always looking over your shoulder. You're wise. You are judging the market constantly. You spend time every single day looking at financial statements, SEC filings, and listening into shareholder conference calls. It's a very time-intensive business, but you've put your money into it, so obviously you've done your research and due diligence, and you continue to do so every single day. Do you think that most retail investors spend as much time as you do? You came here for the truth, so let me unveil that for you. Today we're going to look at several charts talking about what's going on in the stock markets. We're going to talk globally. We're going to look at currencies. I want to talk about many factors that we are presented with today, and I believe this is absolutely crucial to understand. The junkie market is back. Lots of highs and lows. So this blue dot represents greater than 100 new highs and new lows on the NYSE and the NASDAQ. So you can see that we have hit that point yet again. We saw this in 2015. We saw this during the time frame of the financial crisis, as well as the dot-com boom and bust. Now, that doesn't mean that it's going to crash tomorrow. That's not what this indicator tells us. But it's a good sign that there is a dislocation in between reality and what we can see when you look and skim over the surface. If I look at stocks, Apple, Amazon, I'm seeing everything is really strong. It's really great. But look beyond that and understand that a lot of companies today are at 52-week lows. That's never a good sign. We're talking about big companies. Things change as time goes on, but realistically, in the last 10 years, not that much has changed in terms of the way that we see the stock market. It has been completely torn apart here. Things are really different, whereas we shouldn't be seeing that necessarily. Big companies tend to move much slower, but over the last 10 years, we've seen that dislocation, okay? So I just wanted to point to that. This is a very important thing that you need to track on a regular basis. You can look at the market breadth. You can see how many stocks have been hitting their 52-week high. Look how many have been hitting their 52-week low. You need to be accounting for all of that, not just focusing on the stocks that you personally invest in. You need to focus on the market as a whole. That will definitely, absolutely, and in every single case affect you one day. Buyback and capex growth have surged during the first half of 2018. This is showing us the numbers as of the second quarter 2018. S&P 500 year-over-year aggregate capital spending growth. Look at the capex and look at the buybacks. All right, 2018 year to date, 19% on the capex, whereas the buybacks are 48%. We are seeing companies today putting significantly more money, especially in 2018, into buybacks than they do into their own capital expenditures. That's not good. That is not a good sign, but that's what we are seeing today. Billions and billions of dollars are being pushed into these companies, and they are doing this in order to push the stock prices up higher. We know that because the executives, the insiders, have admittedly been selling after the buybacks. So that is a fact. We have determined that already. I've shown you previous videos. Top 10 contributors to the S&P 500 buyback and the capex growth. Well, don't have to look very far. We are seeing this share repurchases on the left-hand side. Apple and Amazon and all the big boys are right here. You can see that for yourself. They're spending billions and billions of dollars. In this case here, year to date, Apple has spent $45 billion worth. And the capex, you will see also, it is the same companies, notably the FANG stocks here. But I want to address something that is very important. You look at the total amount that, for example, Google is spending, $13 billion, a significant amount. But total it all up and you start to realize that the big boys, they're purchasing a lot more shares than they're spending in their capex, and that's never a good sign because of what's happening, because it's a contributor to seeing the stocks rise. And if it's coming from share repurchases, that doesn't show us strength. We need to see them reinvesting into the company as much as possible, giving dividends, because the dividends, you want to see those numbers increase. That shows us they want stability and they want to repay their shareholders by hanging in there over long periods of time. You don't want a crash to come in and suddenly everybody sells. That's just going to put downward pressure on it. Flow winner since Lehman. So we're seeing all the way back from 2008. And what was the big play right then? Money market. You can see that people were uncertain. I don't know what to do. I'll just put my money in the money market. Hopefully everything will be fine. Now in 2009, you could see they're going for the safe havens. They're going for treasuries. They're going for gold. And then we started to get into 2010 where emerging market debt became the hot trade. Then we go into, further along to today. Tech. That's where all the money is, even back in 2017 as well. When I look at this, I have to worry because we've come a long, long way. We've seen that money has been flowing in at such a drastic rate, and the market doesn't know any other trades at this point. It's fleeing from emerging markets, and it is entering into a few stocks. Never a good thing to see that. Active versus passive equity flows since 2009. Clearly, passive investments have been increasing here, and that's not a good for some of these major institutions which have been historically trying to make money off of the fees, trying to make money off of these corporations. This is the way that they handle their business. They have all of this in line, being actively managing people's investments. But today, particularly with ETFs and things, that has really changed. So that's part of this. Looking at the bond versus equity flow since 2009, yes, there has been a lot of equity flows, a lot of money coming in. It's been sporadic, but bond flows clearly much, much higher. But the bond market is definitely bigger anyway. I mean, this is just showing us in this period of time, $2.2 trillion. We have a big problem though. We are heading into a guaranteed disaster. And why do I say that? It's because the Fed funds rate shows us what will happen. The first rate hike here, down here, believe that was December of 2015. And then we can see that they've slowly but surely been stepping up during this time. All right, so we're around that 2% mark today. And the Fed funds rate is unsustainable at much higher values. In fact, I just read to you the article talking about how we are currently at the level where it is very resistive, where it is not a good thing to go higher. That's what the bankers are saying today. We're only at 2%. And when we look back on this, we can see that, maybe if I take a look at this red line, the Fed funds rate, it is maybe 5.3% on the Fed funds going back into 2007. There's no possible way that they can ever get back to that. It's just not possible, particularly at a time where we have the Fed balance sheet being tapered. And of course, the taper is fractional. It's equally as slow as their increasing of the interest rates, but it seems like we're headed towards a death cross. And that is a disastrous event waiting to happen. A $237 trillion record. Global debt climbed by 42% in the fourth quarter from a decade earlier. Nobody even cares. Nobody cares about the non-financial corporates, the government, the financial corporates, and the households, because we owe it to ourselves. Those are some foolish last words. China's credit growth change year over year. I just wanted to show this to you. Taking a look at China's total social finance percentage growth year over year, the MSCI emerging market returns, and the emerging market liquid bond returns. Everything has been declining right here throughout 2018. And look at where it was back during the leading up to the financial crisis. And we could see that it had escalated, but really ever since, it's been weak. All of these markets haven't really done well. Yes, we've seen that in some cases, but their growth has been unable to compare to where it was leading up to the financial crisis. Okay, so that's what I wanted to point out. And last but not least, Steve Eisman. You probably know him from The Big Short. If you haven't read the book The Big Short and you're not into reading, at least watch the movie. I think actually both were good. But he made some comments here. He's talking about how, the market is so safe today and everything's so wonderful. But what he did mention was that quantitative easing was very stupid. And he mentions that just in the paragraph above this, but then gets into this one paragraph I wanted to mention. And that wasn't as successful. In my view, it failed 100%. And I completely agree with that. They were unable to get the economy going using quantitative easing. Now they're stuck with over $4 trillion worth of garbage. So that's what he basically talks about here. It caused the stock market to go up because people took all that liquidity and invested it in the stock market, but it did not cause the economy to grow. It did not cause the economy to grow even 10 basis points faster. I like to nickname quantitative easing monetary policy for rich people. You could quote me on that. They took a shot, it didn't work, and then they doubled down and did it again. Same result. Steve Eisman, in this case, you are correct. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support the channel. I do appreciate when you do that. Just hit that button. That's all you need to do. If you want to comment on the video, just say hello, just say hi, just say Steve Eisman, just say The Big Short, whatever you want. All of those comments help to support the channel, so I do appreciate that. And if you want the financial education you were not taught in schools, these two books have it all. You can check them out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.